Hey everyone. So I've covered how do most of my options trading in selling put options. Um, Most of my profits are selling put options. Selling call options is the other type of option which we haven't looked at that you can sell, right? Now, if you recall, instead of buying 100 shares of some other stock, you would be obligated to provide 100 shares to somebody else who has bought this option for me. So this could mean two things. One is they want me to provide 100 shares and I don't have it, in which case I give them the cash, right? Now I'm just out of pocket. I lose money. So for example, if I sold an Nvidia call option, they at a strike price of, I'm just making this up, $180, and if the price rose from 170 to 180 and beyond, they could exercise that option and force me to give them 100 shares. Or if I don't have that, I just got to give them $18,000, and that cash is gone, right? So you talk about the few $100s, a few $1,000s in profit, and you might make that over a year, maybe you make $18,000. With the one trade, a year's profits is gone. That's what you would do is if you didn't have 100 shares of NVIDIA in that instance. Conversely, you could buy the 100 shares of NVIDIA and just give the 100 shares. And if you bought the shares below 170, let's say 160, you would have made profit. You probably would have missed out on profit. We'll come to that later, actually. So you could have bought the shares at a cheaper price, sold it at some other higher price, at the strike price of 180, and you wouldn't have lost money. You would have still profited because you've bought a load, you sold it at higher price, you've collected options premium, so that's a possibility. So when you don't have the shares, that's a naked call, and when you do have the shares, that's a covered call. Earlier on, when I began options trading, I worked with covered calls, right? Because those were seen as the least risky situation, because the worst case is they just take away shares, you get cash for the shares that you have, you're walking away whole. Those are considered the more risk averse trades that you can make. But however, the reason I think cash secured puts don't get enough credit for being the risk averse type of trade you can make, options trade you can make, is because if you're looking at the whole subset of types of options there are, then yeah, like there's certainly a risk. Like if you're being forced to buy 100 shares of some stock that's like a meme stock, or that's like a GameStop, that's something that maybe it's a really speculative biotech stock that has like one trial out there with the FDA, then yeah, there's certain risk there that you might be might be forced to buy a stock that will never ever go up, and you would lose that money, right? You would eventually have to take a loss of what you bought. But if you're selling put options on strong stocks that have a track record of success, like a Waste Management or like a Walmart, then the risk calculation is a whole lot different for a selling a put option on that kind of stock. Now, besides the idea of just losing cash outright for a naked call option, or losing the shares that you own, there is another consideration in selling call options. So I've talked about before how the stock market traditionally goes up. If you look at SPY, the S&P 500, it traditionally goes up over time. I've also talked about how the stocks I look at, like Nvidia, like Google, like JP Morgan, like Caterpillar, they go up over time. Um, so stocks tend to go up. So the reason why selling a put option tends to be more profitable and why there's more chances for me to profit is because that's a bet on a stock going up, essentially, right? Because the put option gets exercised as the price goes down. That's why somebody bought the put on with me. They thought the price is going to go down. They found me as a seller to buy the option from. With a call option, else is buying the call option because they think that that price is going to go higher than the strike price. So if I'm selling that call option, I'm implicitly thinking that the price is not going to move, even if it's going to move in the direction of the trade with the buyers hoping, it may not reach that point. So if I sell a call option with a strike of 180, I might believe, even though it's going to go up at 180, it won't go past 180 by the time of the expiry of the option, right? So, but there is that more risk, right? Because you're constantly having to assess, is the stock going to go higher by that point in time? And if the price tends to go up more of the time, majority of the time, there's just more of a risk that you're going to see that option get exercised. So that's another consideration with call options. So they make sense when you have bear markets. They make sense when markets have run up, and it's a fairly reasonable guess to think that the price is going to decline and not go up any further. In those instances, yeah, selling call options makes sense. And so nowadays, when I sell call options, I do pick my spots, right? So in summary, the reason why I can't sell call options as often as I can sell put options is, number one, you need to have the capital to have the 100 shares, because I'm not going to sell, I don't sell naked calls. So I would need to have enough capital to put towards buying 100 shares of whatever stock I'm going to sell a call option on. And then two, I have to assess, is this a reasonable time to sell this call option, because I don't think the price is going to go up that much higher, that much faster for this time. A last consideration that I'll mention with selling covered call options, because this will lead into when I talk about my buy and hold portfolio. If I'm going to buy 100 shares of a stock, let's say it's NVIDIA, 18 grand. So let's just say if your portfolio is 100 grand, I mean, that's 20% of your portfolio in one stock. And then let's say you want to buy Microsoft, and I forget where Microsoft is at, to be honest, but it's somewhere I think in the hundreds or 200s. And so let's say that's another 20 grand. Like, you got two blocks of shares and two stocks using 40 grand, right? And if you did another one to Tesla, then maybe you'd have 60 grand. So three stocks, 60% of a portfolio, three high growth stocks. And they kind of, if you're going to sell options, faster moving, slightly more volatile stocks make more money than stocks that are more kind of traditional blue chip, like a McDonald's, like a Walmart, like a Waste Management. If the markets keep going up, the price of those stocks keep going up, then your buying power holds steady. You can keep selling even put options as well. But in instances when the market turns downward, and particularly those three stocks, the value of those holdings that you have, those 100 shares, they decline. But so does your buying power. And if you've been selling put options using that buying power, you're at a greater risk. And if the buying power is declining, you're at a greater risk of being forced to sell off positions that you're in, either close options trades you're in, or even sell shares that you have, right? So that is a risk that you have when you're using leverage, and when it's backed by securities that are somewhat more volatile, somewhat riskier, right? Higher growth stocks. So that's a consideration too when you're trying to sell covered call options. Like, are you actually holding stocks that put your portfolio a little more at risk because you put 60% of your portfolio into three companies that might be more likely to be a little more volatile? So that's another barrier to overcome when selling call options, right? What comes with deciding what you're going to hold and what you're going to trade. I'll elaborate a bit more in a future video about how to decide like what you're going to hold. So that scenario that described, that actually was what was happening to me when I began options trading, right? There were more risky scenarios arising. So I was making more profits on average, but then I was also taking on more risk that I had to manage. And so there was a volatility in my profits in the first couple of years. What I've arrived at is a bit more of a sustainable portfolio with steady profits each month, whether the market goes up or down. That was one of the considerations that led me in toward the current buy and hold portfolio I have that is supported with my options trading strategy. So I'll cover that in future videos. Okay, see ya.